Hello, I'm Chris Pedersen, and this is Stock Watch on Thursday, the 12th of September, 2024. All information is general advice, may not be suitable for you. Always consult your financial advisor before making any investments. All questions from viewers should be sent to stockwatch@fnn.com.au. Here are a few of my market observations. First off, the ASX 200 last night closed just a touch under 8,000. So we've had a roller coaster ride during the month of August and the beginning of September, and guess what? We're back to where we started. Copper is back down to almost $4 a pound. Long-dated bond yields have declined slowly over the past 3 weeks, giving holders a decent profit. The US last night was a roller coaster. It opened down and then ended up, at the end of the day, up a decent amount. Here are a few charts I wanted to share with you. First is small business in Australia. What this shows is that Australia's economy has more small businesses contributing as a percentage of overall GDP than other major economies like the US, UK. Here's another chart that I got from McKinsey. It's absolutely fascinating. One trade in the market is that at the end of every quarter, the various indices have inclusions and exclusions. That is, companies that are now going to be in the index and companies that are taken out of the index. The trade is that you buy these companies that are going to be included and hold on to them, and companies that are going to be excluded, you sell, get out. That makes sense because that index funds are big buyers and will hold forever. And the companies they sell, they're not going to be going back in. However, what McKinsey found is over a period of time that during a 1 to 2 month period, stocks being included will go up. After the date that they get included, they tend to drift back down, where 1 to 2 months later, they're back to where they were. Thus, this movement is only temporary. That is a surprise to market operators. This chart shows companies that are being excluded. Again, you see they sell off, then at the end of the quarter, they start to drift back up to where they were before the sell-off. Small business in Australia, well, this shows us that we're doing pretty good in terms of employment. This is a number of job ads and job openings, how many people are applying on a per unemployment basis. This is new aircraft demand. What we see is that demand for new aircraft is significantly greater than old aircraft being retired. This is good for airline stocks like Qantas. 3 companies I wanted to cover today. The first one is ASX Limited. They had a report on the 16th of August, and their chairman, by the way, resigned, and we're looking at a change in the board structure. ASX last night closed at $64.45. This long-term chart shows us the problems the ASX has had. It peaked near 100, and it's been fairly steadily on the decline. Let's take a look at the numbers though. These estimates are from Macquarie. There's a market cap right now of $12 billion. They have a price target of 61. Revenue growth rate from 2024 to 2027 is only 5.4% per annum. That's okay, but stock exchanges around the world tend to have higher revenue growth rates than that. The EPS growth is pretty anemic. During this period, it's 2.4% per annum, and the dividend growth is exactly the same at 2.4%. So because of these kind of slow numbers, I wanted to take a look at shareholder equity growth, and surprise, it's flat. So the only thing you're really getting out of the company is the dividend. The PE on the 2026 earnings estimate of $2.63 is 24.5 times. For me, a company growing that slowly with a PE of 24.5 is overvalued. The yield on the 26 dividend estimate of $2.23 is only 3.5%. So you're not buying this for the yield. Free cash flow is only 2%. Payout ratio is 85%. Now it used to be 90%, but they've lowered it to 85% because they have more technology costs and system costs and rejuvenation of their clearing and settlement and other divisions. The Australian Securities Exchange has listings, share trading, derivatives, futures, settlement, clearing, and data. I rated it neutral. I'm not too bullish on the company. there has to be some major turnaround for this company to really start growing again. Endeavour Group closed last night on the ASX at $4.99. Its code is EDV. This company was spun off from Woolworths, and if you know Dan Murphy's, well, then you know Endeavour Group. Here's a price chart. It's also not very attractive. Just like the ASX, it's in a downtrend. It tried to rally, but it's given up the ghost. The numbers here from Citibank are telling us that this company also has slow growth. Let's look at the numbers. 12-month price target they have is $5.18. It's a market cap of $9 billion. The revenue growth rate for each of the next 3 years is only 2.6% per annum. The earnings growth during this period is 5.4% per annum. That's a little bit better. And the dividend growth is 4.8% per annum. Looking at shareholder equity, it's growing at 3.5%. So this company is growing just a touch more than the inflation rate right now. Take inflation, add population growth, this company is stagnating. The PE on the 2026 earnings estimate of 30.9 cents is 16 times. The yield on the 2026 dividend estimate of 23.2 cents is 4.6%. Free cash flow is 4.4%, and the payout ratio is 75%. So they're the largest alcohol retailer in Australia, and the major brand, as I said, is Dan Murphy. The tax on alcohol every 6 months, these increases hurt affordability, and it's hurting Dan Murphy. I rated a neutral. Platinum Investment Management is the third company today. The code on the ASX is PTM, and it closed last night at 94.5 cents. This is a chart that's like a 3-year chart. I've showed this before. This company is not performing well. It's losing funds under management. However, let's look at the numbers and see if there's some positive to it. These estimates, by the way, are from Goldman Sachs. Platinum is now a market cap of only $600 million. 12-month price target that Goldman has is $1. The revenue growth rate that they have is negative 6.9% per annum for the next 3 years. Earnings growth is flat, dividend growth is flat. The PE on the 2026 earnings estimate of 8 cents is 12 times. The yield on the 2026 dividend estimate of 8 cents is 8.5%. So that's a good yield, but is it sustainable? The cash, which is what makes Platinum attractive to many, is it has $121 million of cash on the balance sheet, and it's estimated to go up to $125 million next year, $130 million the following year. So this company has plenty of cash, doesn't really have debt. It has room to grow by reinvesting in their business. The payout ratio is 95%, which I think is too much, but I understand their logic right now. Investment management company specializing in international markets. They have an excellent new CEO. My view is wait for the turnaround. I'm neutral now, watch it, but I'm confident the new CEO will make changes for the better. As always, if you want to learn more about anything I covered today, send an email request to stockwatch@fnn.com.au and direct it to me, Chris Pedersen. Hope you have a wonderful week. Thank you.